WatchGuard Capital. Invest your time wisely. And this video is a performance update on the first 2 quarters of 2022 and a review of what the recent spike in inflation means going forward. This is a performance heat map set to 1-year performance, and it shows the performance from June 6, 2021 to June 6, 2022. Green means up, red means down over that time frame. And as you can see, there was a lot more red over the last year. And in this video, I explained why SPY, VTI, and the Triple Qs are some of my favorite core investments to build a portfolio around, but even those investments were down 2.8, 6.2, and 8.7% respectively over that time period. US small company stocks were down 17%, international developed stocks down 14%, and emerging market stocks down 24% over this period, so broad-based stock market investments were all highly correlated and all down. And that's a known risk, but what is really annoying is what happened in the fixed income and bond markets. Typically, more conservative portfolios will have a higher allocation of fixed income and bonds, as indicated by the green allocation, than moderate or aggressive ones, which may not have bonds at all. But broad-based bond funds were down 10% over that time period, so there really wasn't much of a risk reduction at the portfolio level for owning bonds during the last year. Long-term treasuries were down about 17%, investment-grade corporate bonds about 14%, and high-yield corporate bonds, which have more principal risk, fared better than both of those bond types and were only down about 10%, which is something you would not expect to see in a risk-off trading environment. And if we change to a year-to-date 2022 performance view only, we can see that most of the negative performance occurred in the first 6 months of this year, with SPY, which follows the S&P 500, down 13%, the Triple Qs, which follows the NASDAQ 100, down 22%, long-term treasury bonds down 23%, and broad-based bonds down 11% year-to-date. So the first 6 months of 2022 have been absolutely horrid for investment returns. But short-term corrections are not my biggest concern, and I know that selling after a correction is not a recipe for success. My biggest concern is national debt, and here is why. These are the annual financial reports for the United States government for 2015, 2017, 2019, and 2021. And in these reports, you can find these tables of information, which I'll go into deeper in a future video, but will stay fairly high level in this one. Each table shows information for 2 years, so we have information for 8 total years, 2014 through 2021. In 2015, our stated total liabilities were $21 trillion. Our stated total assets were $3 trillion, leaving us with a net position of negative $18 trillion, which we'll designate with these $18 bills. If we as Americans didn't want our net position to deteriorate beyond negative $18 trillion, we needed to figure out how to cut spending or increase tax revenues by $4.1 trillion in today's dollars over the next 75 years, which was totally doable. But we didn't do that. Instead, we increased spending and kept taxes flat. So our net position deteriorated to negative $20 trillion. To which the Department of the Treasury responded, okay, so we've updated our assumptions and now you need to find a net present value of $16 trillion over the next 75 years. To which Congress responded, thanks, but no thanks. We're actually going to do the exact opposite of that and increase spending while passing the 2017 Trump Tax Cut Act. And our net position deteriorated to negative $23 trillion. The Department of the Treasury updated its assumptions and responded, no joke, you do what you want to do, Congress, but you now need to find a net present value of $49 trillion over the next 75 years. And then COVID happened, all types of additional stimulus spending occurred, our net position deteriorated to negative $30 trillion, and the Department of the Treasury updated its assumptions and said, hey Congress, if you want to keep Social Security, Medicare, and military programs on par with what they are today, you need to find a net present value of $97.6 trillion over the next 75 years. So my biggest concern is that our position deteriorated 2,280.5%, or $93.5 trillion for the next 75 years in only 7 years. Which means the 7% inflation we experienced in 2021 and the 9% inflation we are on track to hit in 2022 might be here for a while. So I needed to go back to 1973 to 1981 to review how inflation at these levels should impact investment recommendations. So let's do that. First, a big shout out to PortfolioVisualizer.com for building this backtest portfolio tool and making this analysis extremely easy. I'm going to run an analysis for 50 years from 1972 to 2022. And I like to set the initial amount to $100 so that I can convert any calculations to percentages quickly. And I'm going to backtest 3 portfolios. Portfolio 1 will be 100% US stock, Portfolio 2 will be 100% intermediate term treasury bonds, and Portfolio 3 will be 100% cash. All stocks, all bonds, all cash. and those are the underlying data sources. Stocks had a 10.5% compounded annual growth rate with a 15.6% standard deviation, and the initial $100 investment grew to $15,314 over 50 years. Intermediate-term treasuries had a 6.5% compounded annual growth rate with a 5.7% standard deviation, and the initial $100 investment grew to $2,479 over 50 years. And cash had a 4.5% compounded annual growth rate with a 1% standard deviation, and the initial $100 investment grew to $938 over 50 years. One other thing to point out is that the worst year for intermediate-term treasury bonds was negative 6.5%. That's this year. And I love this graph because it shows the growth of the initial $100 investment in stocks, bonds, and cash. But also because you can set the graph to be adjusted for inflation to see what those final balances would be worth in the starting year, in this case 1972. So the $15,314 final balance in the stock portfolio would have the purchasing power of $2,177. The $2,479 bond portfolio, the purchasing power of $352. And the $938 in the cash portfolio would have the purchasing power of $133 in 1972 equivalent dollars and 1972 equivalent prices. So obviously the $100 investment in the stock portfolio provided both the best nominal return and the best real return after being adjusted for inflation. And you can see a bar graph of annual returns, and the only other time that both the US stock market and intermediate-term treasury bonds were both negative was 1994. Almost 30 years ago, when the stock market was down 0.17% and treasuries down about 4%. The last thing to do is download the annual returns and formulate our expectations. Let's start with cash. Those are the returns, and that's the balance of the portfolio over the 50-year time span. A quick calculation to figure out the equivalent price of $100 in 1972. So a $100 item in 1972 would have cost $704 in May of 2022. Which means that if you lost a $100 bill on your couch in 1972 and then found it in 2022, its value would have dropped down to about $14 of 1972 purchasing power. And as a reminder, I'm concerned about national debt and inflation, and I want to see how investments reacted to inflation at these levels. There's no scenario that I think the government can afford a 3-month treasury yielding 4 to 15% anytime soon, so I'm not going to use these returns, and instead I'll use these ones. And I'll pull them over here, and I'll subtract the inflation from 1972 to 81 from them, and I'll find that the real return is negative for every year. So in this case, I believe cash will yield 0 to 1% nominally and generate a negative real return of 5 to 6% once accounting for inflation, for at least the next couple years. Next, let's look at how the US stock market did over the 50-year period and also how it did during the high inflationary period. So let's pull those returns over here, subtract inflation, and we find a positive real return in up years and a negative real return in down years, which makes sense. These double-digit inflationary years could happen, but it's so far above anything I've experienced, it's hard to believe that it's likely, so I'm going to adjust my real rate of return expectations accordingly. So I think stocks will average 9 to 13% over the next 5 to 10 years, but that it'll be extremely choppy and it will generate a real return of 4 to 6% annually. And let's do the same analysis for the bond portfolio, and here's how it would have grown over 50 years. Here's the 10-year treasury yields over that time period. In the 70s, the average yield was in the 7% ballpark. Today, it's in the 3% ballpark. So I'm going to use two different methods to establish expected returns on this asset class relative to higher inflation. The first method is to take the most recent returns, move them over here, subtract inflation, and derive the real rate of returns, which unfortunately appear to be negative, so let's try the other method, which will involve taking the bond returns experienced during the high inflationary period and discounting them by some appropriate factor. In this case, I selected 2% to be on the conservative side to adjust for the fact that the average yield on today's intermediate treasury bonds are in the 3% ballpark and not the 7% ballpark. Once discounted, these are the adjusted returns, subtract inflation, and we actually get very similar negative real returns as the previous method. So unfortunately, I don't think bonds or cash are going to generate a positive real rate of return over the next 5 to 10 years, which leaves real assets like stocks, real estate, precious metals, and possibly an options overlay to generate income and hedging. Because we've had low inflation in the 2 to 3% range for 30 years now, but if we have inflation in the 5 to 6% range for the next decade, as I'm predicting, the value of our dollar's purchasing power is going to decline at a much faster rate. Under a 2% inflation rate, the purchasing power of a 2022 dollar declines to about 78% in 12 years. Under a 6% inflationary scenario, our dollar loses half of its value by 2034 because prices would have doubled. If you are a WatchGuard Capital client, I'll be reaching out to discuss strategies to protect against this risk. And if you're not, but would like to keep updated on our national debt problem and investment ideas, subscribe to this channel. For now, I am Stephen with WatchGuard Capital, reminding you to always invest your time wisely, because inflation is back.